Hey guys, it's Aman
And Christina
from Our Rich Journey. On today's video, we are talking about the rise that is happening in interest rates. And if you are investing in the stock market, 2022 could be a very bumpy ride if you don't understand how interest rates are going to affect your investments. And so on today's video, we are going to talk all about interest rates and how they can affect your investments in the stock market. We are also going to talk about some of the things that you should and maybe should not be investing in when it comes to higher interest rates.
So interest rates have been at all-time lows for the past 2 years, and I'm talking about all-time lows. But these interest rates have actually been pretty low since the 2008 economic crisis. So now that interest rates are going to be going up, it's really important to understand how this rise in interest rates can impact the stock market and your stock market investments. So in order to get started with this discussion, let's first talk about what we mean by interest rates.
Yeah, I love this definition because you'll often hear people just throw the term out, interest rates are rising, but really, what are they talking about? And that's what we try to do on this channel. We try to make things as clear as possible and speak in plain English. So when we are talking about interest rates, we are referring to the federal funds rate and how that rate affects most borrowing and credit rates. So the federal funds rate is determined by the Federal Reserve, and it is a target rate that banks will use to borrow from the Federal Reserve and also lend money to one another and to consumers. So when I'm talking about consumers, I'm talking about everyone from corporations to the everyday Joe that uses credit or borrows money. Now, the Federal Reserve meets 8 times a year to determine what they should do with this target rate. By changing the federal funds rate, the Fed can alter the cost of borrowing in the economy, which in turn affects the demand for goods and services in general. For example, lower interest rates means cheaper credit, which in turn causes businesses and consumers to purchase more, boosting sales. And so the rate is used to promote economic growth. And if you look at how the Federal Reserve has used this rate since 2008 to spur the recovery after the crash, and in 2020 to get out of the 2020 crash, they have lowered this rate to do exactly that: promote growth, promote recovery.
So this makes the federal funds rate one of the most important factors impacting the US economy. It can impact things like inflation, employment, how people spend their money, the stock market. There are so many different things that are impacted just by this single rate. So the low rates that we've been having up until now are very attractive to investors for 2 reasons. The first is that it can boost economic growth, meaning more profits for companies. The second thing is that lower interest rates make investing in the stock market generally more attractive than holding money in a bank or in bonds.
Now, on the other hand, higher interest rates can have the opposite effect. They can mean less profits for companies, and the reason for this is because higher rates can result in less spending. And what happens when people spend less? The economy grows at a slower rate. Sometimes it may not even grow or go backwards, and that hurts companies. So companies that were profiting from lower interest rates and people spending money aren't gonna see that same type of spending from consumers when interest rates rise. The other thing is that there are many companies that rely on low interest rates to fund their operations. And so when interest rates rise, so do their expenses, their expense to borrow money to support their company. Now, this could result in a shrinking of profit for these companies, and it could also result in some of these companies even failing if they can't support the new payments because of the higher interest rates. And there's something else that needs to be mentioned. When interest rates go up, less people are willing to borrow money to invest in the stock market. Now, we think that's always a bad idea, but there are many people that do this on a regular basis.
So, when the Federal Reserve gets on TV or anywhere else and gives any indication that interest rates may go up, then the stock market generally tends to act or shift accordingly. Now, just because interest rates go up, it doesn't mean that all stocks or all corporations will be impacted in the same way. So, this leads to our next question is when you know that interest rates are going up, how should you be investing in the stock market?
So I love this particular question, especially because we know right now that the Federal Reserve is going to raise interest rates at least 3 times this year, maybe even more, to combat inflation. And so when you are putting together your investment plan and deciding on where you want to put your money to work in 2022, there are some things that you should keep in mind. The first thing is that when you are investing in individual stocks, the financials of these companies matters a lot at a time like this, especially companies that have a lot of debt. So companies that are involved in telecom, manufacturing, shipping, and construction. So these would be companies like AT&T, Ford, or CVS.
Now, just to be clear, the financials of a company always matter when you're investing in individual stocks. You should always be looking into this. But when the economy is booming, a company can still have poor financials, but still do really well. So you could be still making money by investing in these companies. It's when interest rates begin to rise when you may see that discrepancy between companies that have really good financials and other companies that don't.
So when a company has a lot of debt, that puts them in jeopardy when interest rates rise. Now, on the other hand, if a company has a lot of cash, does not have a lot of debt, has limited the amount of debt they have, these companies tend to fare better when interest rates rise. So when you look at some companies like Google, Apple, Facebook, these technology companies that have a lot of cash on hand, that have not run up their debt when interest rates were low, these companies are in better shape financially when interest rates rise.
So just to be clear, there are many other factors impacting the success of a company, but that's something to keep in mind in terms of the financials and the amount of debt that that company has. Now let's talk about another type of investment that can be impacted by high interest rates, and these are high risk assets, something like cryptocurrency.
Now we bring up cryptocurrency because cryptocurrency has been one of those assets that has done really well in a low interest environment. You see, many people invest in cryptocurrency like people used to invest in gold. They are investing in cryptocurrency because they see it as a hedge against inflation. And so when inflation starts to come down, cryptocurrencies may not be as attractive. And we've seen recently cryptocurrencies have come down significantly. Bitcoin and Ethereum are down more than 30%, and some of the alternative coins are down even further. Another issue with cryptocurrency investing is that many people borrow money to invest in cryptocurrency because interest rates have been so low. That's not going to be the case when interest rates rise. So that is something else to keep in mind.
And another thing about high risk investments, not just cryptocurrency, but any other type of high risk investment. When the economy is doing good and people have extra money to invest, they feel that extra sense of ability to invest in something a little riskier to try and see if they can gain more money. But if the economy is not doing well and people don't have that extra money to spend, they're less likely to want to spend what little money they have on riskier investments.
Now, this is an excellent point because cryptocurrency has been one of those things where money is just flowing in the streets and people feel like they can throw it at cryptocurrency. But as the economy starts to tighten because interest rates rise, people will start to be more conservative in investing in cryptocurrency. So if you're one of those people that likes to invest in high risk assets like cryptocurrency, now may be the time to be more critical about those investments. The next thing I want to talk about are investing in bonds. Now, bonds are debt securities issued by corporations, governments, municipalities, or others. They are considered to be low risk and lower reward than stocks. You see, bonds are significantly affected when interest rates change. And one of the things, a rule of thumb, is that you want to avoid fixed rate long-term bonds when interest rates are rising. You see, the longer the term the bond is, and if you are locked in at that rate, you are taking on more risk with that bond.
So I'll give you an example of why you'd want to avoid a fixed rate bond when interest rates go up. So let's say you purchase a fixed rate bond today and it's at a certain rate, and then interest rates go up. That means maybe tomorrow, for example, you could buy that same bond at a higher interest rate. So which means that the bond you bought today is going to have less value, especially if you go to try and sell it or you go to try and redeem it in the future.
So avoiding fixed rate bonds is a strategy that is used when interest rates are continuing to rise. And like we said earlier, the Feds have said that interest rates will be going up. So it's very hard to invest in a fixed rate bond today, knowing that at some time in the future, interest rates will rise and your bond will be less valuable because there will be other bonds that are more valuable.
And I think this is so important to understand because when we talk about investing in the stock market, for example, we always say you never know how the stock market is going to behave. It can go up or it can go down. But with bonds, with interest rates specifically, the Feds have told us that they are going to be raising interest rates at least 3 times this year. So you understand how those rising interest rates can impact your bonds.
Now, the federal government can always change their mind and decide not to raise interest rates, but the writing is really on the wall. Now, a solution to this for those people that still want to invest in bonds is to invest in bonds that aren't fixed rate, that have a variable rate. And there are a number of different types of bonds that will readjust based off of the current interest rate. There's also shorter maturity bonds that you can invest in, and that way you can avoid some of the downfalls of higher interest rate. For example, a lot of people will do what's called a bond ladder, where they are investing in short-term bonds in increments of 6, 9, 12, 24-month increments. And every time a bond matures, they move that money over into a new bond that is at a higher rate. This is typically what is done when interest rates are rising.
So let's talk about the last investment that you may want to consider and research and see if that will work for your portfolio, and that is the index fund. Now, we already talked in this video about the impact of high interest rates on individual companies and how to try and think about that as you're developing a portfolio of individual stocks. Now, what happens if you take all of these things into account, you go for a company with great financials, but you still end up getting it wrong? Like we said, there are so many different factors that can impact how well a company does. So if you pick a company and it does poorly, that can really impact your portfolio, especially if you plan on selling off your investments in that portfolio. Now, on the other hand, a total stock market index fund provides for more diversification. It includes that company that you would have picked, but it also includes all the other companies on the stock market. So when we see rising interest rates, some companies may not do as well, but money within the stock market just shifts to other areas in the stock market because some companies will also do very well. So when you're looking at a total stock market index fund, that diversification can help you as you're trying to build your money or your wealth in your portfolio.
You see, this is such a powerful point that you are not going to hear on some of these investment shows. They only want to talk about investing in individual stocks because that's sexy. But when it comes to investing in index funds, all of this anxiety about rising interest rates is mitigated. Because when you invest in the total stock market, you are capturing the winners and the losers. And throughout history, by just investing in the total stock market, the winners outpace the losers because the total stock market has consistently gone up over history 8 to 10%, even during times of higher interest rates. And so we bring this up because we know what we're going to do when interest rates rise. We're going to do what we have consistently done, and that is invest in the total stock market. But we want to give you guys food for thought so that you can do your own research when you're developing your portfolio at a time like this. And so if you guys have liked this video, if we've given you food for thought, we want you guys to do 3 things. The first thing is to check out our Investing for Financial Independence course that we will leave as a link in the description below. This course is all about investing in the stock market and will give you the confidence you need in order to invest for financial independence. Now, you can check the link in the description below, or you can visit our website at ourrichjourney.com. The second thing is to help spread the word about financial independence and retiring early by liking, subscribing, and sharing this YouTube video. And the final thing you can do is, as usual, join the journey.